Hello friends, DK this side. In this tutorial video, especially meant for stock market beginners, we will discuss about P ratio and PEG ratio, which are two very important financial ratio for assessing the valuation of a stock at the current market price. Now the question arises is, which one is better? So in this video, we will learn what is P ratio, what is the meaning of P ratio, and then we will learn what is the meaning of PEG ratio. And then we will conclude which one is better to assess the valuation of a stock at current market price. So friends, don't forget to like the video and subscribe the channel, hit the notification bell for updates. Let's begin our discussion on this very aspect of fundamental analysis in the stock market. Let us first understand what is the P ratio. It is a financial ratio making a comparison between the stock price in the market currently at which it is trading to earning per share. It is that simple. So it is a ratio of price to earnings. And that is why it is called price to earning ratio. Sometimes it is referred as earning ratio. So if it is a ratio, it has two variables. One is the price of the stock in the numerator, and in the denominator, it has the earning per share. So stock price is continuously changing every day in the stock market. It is going up, coming down. So P ratio is continuously changing. When quarterly results come of a company, then the earnings are declared. So the EPS changes. So these are the two variables in the market. Since it is a ratio, if the price goes up, the stock becomes expensive. If the price falls, the stock becomes, in terms of valuation, that much attractive. And if earnings of the company goes up, obviously the P ratio will come down. So it is a valuation matrix to understand the valuation of a stock at current market price. So in one line, we can say lesser the P ratio is the better in terms of valuation for that particular stock. Let us take a simple example to understand how P ratio is calculated. For example, a stock is currently trading at 500 and its earning per share, that is EPS, stands at 18. So 500, that is price, divided by 18, that is EPS, earning per share, will calculate to 27.77, which is nothing but the P ratio or price to earning ratio of this particular stock. With the basic understanding of price to earning ratio, that is P ratio, now let us move to understand what is PEG ratio. Before we understand the very formula of PEG ratio, let us understand the meaning of each word in PEG ratio. That is P, E, G. P stands for price, E stands for earning per share, and G stands for growth. What does it mean? That PEG ratio considers the estimated growth of a company in terms of earning. So PEG ratio can be simply defined as price to earning to growth ratio, which means P ratio is calculated first, divided by the estimated growth of earning of the particular company. So these two valuation metrics to do the valuation analysis of a particular stock looks similar, but not the same. So what was the necessity for a PEG ratio? Let us understand this with an example. There are two stocks, namely stock A and stock B, and both belongs to the same sector. Stock A has a P ratio of 15, while stock B has a P ratio of 25. If we see this P ratio of this sector, it is at 18. So here what it looks, if we make a comparison with P ratio of a company with the P ratio of the sector, obviously stock A looks less expensive and better in terms of valuation in comparison to that of stock B. But just imagine, friends, if we don't consider the future growth estimate, the possibility of a company growing faster than the other company, then probably PE ratio on a standalone basis can be a misleading valuation matrix. Now we have seen two stocks, stock A and stock B, belonging to the same sector, and found that PE ratio of stock A is less than the PE ratio of sector. To that extent, stock A looks better in terms of valuation in comparison to that of stock B. Now let us calculate the PEG ratio of these two stocks. So if we consider stock A, which has a PE ratio of 15, has an earning growth estimate and forecast of 12% per year, while stock B with a PE ratio of 25 has an earning growth forecast of 26%. Now we have just seen the formula of PEG ratio. So let us calculate the PEG ratio of these two stocks. So PEG ratio of stock A will come 15 divided by 12. That is PE ratio divided by the earning growth forecast. So it comes at 1.25. When we calculate the PEG ratio of stock B, so it will be 25 divided by 26, which comes at 0.96. Now here see, PEG ratio in this scenario, considering the growth forecast of a company in terms of earning, the PEG ratio of stock B is coming less than PEG ratio of stock A, which implies that stock B in fact is a less expensive stock in comparison to that of stock A. With this conceptual clarity about the PE ratio and PEG ratio, these two important financial ratios, to do the fundamental analysis to understand the valuation of a stock at the current market price, how to put these two financial ratios in actual use when we do the fundamental analysis of a stock. Best way, in my opinion, is first let us check the PE ratio of a company. Then make a comparison of that PE ratio with the sector's average PE. If the PE ratio of the company is less than the sector's average PE, what does it indicate? That broadly within the sector, the stock valuation is good. Now the question arises is whether this stock is undervalued or overvalued. There are two different aspects. One is valuation is looking good. Another is whether the stock is undervalued or overvalued. So when PEG ratio is less than 1, it is undervalued. And when the PEG ratio is over 1, it is overvalued. PEG ratio of less than 1 will only come when the company has a very good growth forecast in future. The company is going to grow much faster than its peer group. I hope, friends, this small tutorial on key financial ratios will certainly give some kind of value addition to you. Give a lot of thumbs up to this video. Share this video. Don't forget to subscribe the channel. Hit the notification bell for updates. Looking forward to meet you very, very soon.